Hi, in this video we'll look at another source of risk in financial assets, and this will be liquidity risk. So what is it? Well, liquidity risk is when an investor, a business, or a financial institution cannot meet its short-term debt obligations. So just to cement this idea a bit more, we can look at what the definition of liquidity is, and it's the ease with which an asset can be converted into cash without affecting its market price. So we have some liquid assets, which are just cash or cash equivalent. So if we have just US dollars, that is a very liquid asset. We can use it to buy things and it is just already cash. But there are some things that are equivalent to cash. Well, different currencies are also cash themselves, but say cryptocurrencies are pretty equivalent to cash, and things like gold, these can be used to purchase things, or they can be converted into cash very quickly just by selling them. And on the other side, we have illiquid assets, so assets that are not liquid, things like houses, cars, and land. These things will take a lot longer to sell or to convert into cash than, say, gold. Obviously, for selling a house, there is lots of paperwork you have to go to, and just generally because these things are quite expensive, people will need to, say, look at the asset, ensure that it is the right fit for them, that it's, well, have it, say, valued by an assessor, and so on. So these are illiquid. They take a lot of time to sell. Or, as if we look at our definition for liquidity, we could sell a house very quickly if we were to reduce the market price. If we want to sell the house for what it's worth, if we have, say, a house that's worth £1 million, if we want to sell it for £1 million, we're going to have to go through this process. However, if we reduce the price to, say, £50,000, someone may be willing to take this off our hands very quickly because it's a good deal, but maybe not even then, because they may think that they're being scammed or something like that. But that's what liquid versus illiquid is, and so this is how it ties into liquidity risk, where we may not be able to meet our short-term debt obligations because we don't have enough of these liquid assets. We don't have enough cash. Instead, we have lots of these assets which are very difficult to sell. And so if we are obligated to pay some bill or fee in the short term, we may not be able to do that because we can't get enough cash. Let's make this idea a bit more concrete with a quick example. So imagine that we just have some individual that owns £10 million worth of houses, and we've said that houses are illiquid assets, so they're very difficult to convert into cash quickly. And this individual has just spent all of their money on houses. This may be one house or, say, 20 houses that sum up to £10 million, but they've left themselves no cash in the bank just to pay their basic bills, say electricity, heating, and water, and so on. Well, there's not much point owning all these houses if you can't pay for the basic bills. You can't even get the lights on. So this individual is going to have to sell their properties in order to pay their bills. But you can't just, say, wait for this house to sell, and it can take months to get a sale through, because you have to pay your bills almost immediately. A lot of bills you have to pay, say, up front, you pay for the month. So you're going to have to sell this property, and you'll have to, as we mentioned before, you have to reduce the asking price in order to find a buyer quickly, and so you can make really big losses on this property. If it's just one property, you might have to sell for, say, £5 million, and you just lost half of your investment simply because you didn't have enough cash in the bank to pay your bills. So this is a key problem. Say, for individuals, you need to have cash in the bank in order to pay for your short-term debts, buy food, electricity, and so on. But the same is true for companies. They need cash in the bank to pay their expenses, things like rent, in order to run their factories and to buy, say, raw materials, just in order to produce goods that they then sell on. And there are loads more expenses that are just very short-term expenses for a business. But if they don't have enough cash to pay for these things, then the business could be in serious trouble. They're not able to actually operate as a business, and so they're not going to be able to make any profits because they can't even buy, say, the basic materials in order to produce their goods. And that's why investors often look at the liquidity of a business, so the ease at which their assets can be converted into cash without affecting their market price. And that just allows them to determine the level of risk within an organization. If a business is not very liquid, i.e. they don't have much cash, there is a risk that this business will run into financial issues, so their stocks or assets are worth less. If a business has lots and lots of cash, you're not going to be worried that they're suddenly not going to be able to operate anymore, because you know that they're going to be able to pay their rent, they're going to be able to pay for raw materials. So even if they aren't performing very well at the moment, they still have flexibility with this cash, and that's really what liquidity is about. You have flexibility that you can do whatever you want with it. If you have cash, you can invest this into whatever, so even if your business is doing badly, you have options in order to recover. But if you don't have any cash, there's not a lot you can do. You need time in order to sell your assets and to generate cash. This isn't just about individuals, and it isn't just about companies, but the investors themselves also care about how liquid their investments are. It's much lower risk to hold an investment that is highly liquid. So, i.e., it's the lowest risk investment you can have is just to hold your money in cash in, say, a current account, or to physically have banknotes under your mattress, because you can do whatever you want with that money, and it's more flexible. Longer term investments that can't really quickly be converted into cash are higher risk, so investors require a higher return in order to invest in them. Investors will thus usually try to ensure they have some percentage of their wealth in liquid assets, so they have enough funds to cover their short-term expenses. And there are different schools of thought around how much cash to hold, but say someone may want to have 10% of their portfolio just in cash, just in case they have any short-term expenses. And then they may say invest 50%, into stocks. You have a certain percentage in bonds. You have a certain amount, say, in your house. If you just have a house, or if you're investing in real estate, and so on. So you will tend to want to break up your portfolio into different levels of liquidity, but the point is that you have some amount of cash. You always need to have some amount of cash so that you can pay for food, so you can pay your electricity bill, and so on. And that is just a bit of background into liquidity risk. So I hope this video was interesting. If it was, please do leave a like rating. Check out the other videos on the different sources of risk in financial assets, and subscribe to add some econ to your subscription feed.